Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. It's 2026, February 13th, and today the market basically heard one word, cooler, and immediately started acting like it found a coupon for lower interest rates.
I love when Wall Street gets one slightly chill data point and goes, great, we're cured. Like inflation is a seasonal allergy and CPI is the antihistamine.
In 6 minutes, we'll hit 3 stories: the CPI print and why yields fell, what core and services inflation mean in plain English, and oil sliding toward a weekly loss, plus what all of that means for your wallet.
And we'll do it without telling you to just buy the dip, like your brokerage app is a motivational poster. So the number was a miss, which is hilarious because when inflation misses, everybody wins. It's like missing your flight, but the airline hands you a free vacation.
What happened next? Bond yields fell and stocks bounced off session lows in a classic rates relief move. The simple version is, when investors think the Fed can cut sooner or cut more, future interest rates look lower, and that changes today's prices.
Explain it like I'm 5, and also like I'm trying to refinance my mortgage while my lender pretends not to see my emails.
Imagine interest rates are gravity. When gravity is expected to be lighter in the future, long-term bonds and growth stocks weigh less today, so their prices can rise. For mortgages and auto loans, falling Treasury yields can eventually translate into slightly better borrowing rates, though not overnight.
So CPI is basically the weather report, and the bond market is the guy who immediately changes all weekend plans because it might drizzle.
Why it matters for normal people. If inflation is genuinely cooling, real wages can catch up, and the Fed gets room to ease without reigniting price pressures. But if this is a one-off, markets can whipsaw, especially rate-sensitive assets like tech stocks and longer-duration bonds.
Okay, but the scary phrase is always core and services. Core sounds like gym content. Services sounds like my phone bill, mysterious and rising for no reason.
Story 2. Underlying inflation, often proxied by core CPI, can accelerate even when headline looks calm because energy can fall while rent, insurance, healthcare, and other services stay firm. One item noted core CPI up 0.3% month over month, with services costs picking up.
So headline CPI is like your total restaurant bill, and core CPI is the bill without the happy hour margaritas line item. It tells you if the place is expensive even when you skip the fun stuff.
Exactly. The Fed watches the sticky parts because they don't reverse quickly. Services inflation is often tied to wages and housing, things that adjust slowly. That's why one cooler headline print doesn't automatically mean victory.
Energy prices can do a dramatic fainting spell, but rent is the villain in a long-running TV series. It keeps getting renewed.
Actionable takeaway. If you're adjusting your investments on the rate cuts are coming theme, balance it. Consider not just equities, but also the bond side. Intermediate treasuries or high-quality bonds can benefit if yields trend down, while keeping some cash or short-term instruments for flexibility if inflation reaccelerates.
Speaking of reaccelerating, oil. Because nothing says surprise inflation like pulling up to the gas station and seeing a number that looks like a luxury handbag price.
Story 3. Oil headed for a weekly loss, with traders weighing the prospect of higher OPEC Plus supply against U.S. Iran nuclear talks and broader risk sentiment earlier in the week. Lower oil can help headline inflation, but it can also reflect softer demand expectations.
So oil falling is either, yay, cheaper Phillips, or, uh-oh, the economy is tired. Markets really are a choose-your-own-adventure book written by a caffeinated economist.
Quick recap. CPI came in cooler than expected, and markets leaned into rate cut bets. But core and services inflation remain the slow-moving pieces the Fed can't ignore. Oil sliding could ease headline inflation, yet it also carries a growth signal, so watch both price and context.
And your practical homework, don't marry a narrative. Date it. If the next data print changes, you change. Politely, without throwing your portfolio into a dumpster behind a Wendy's.
If this helped, subscribe to BD Daily Finance News Podcast and share the episode with someone who thinks CPI is a new streaming service. Leave a comment. Are you watching mortgage rates oil or the March Fed meeting expectations next.
Also, if your group chat is doom scrolling, send them this. It's cheaper than therapy and only slightly less regulated.